Welcome to Wall Street Confidential. I'm Aaron Task, joined now by Jim Cramer, of course, co-founder of TheStreet.com, host of Mad Money. Jim, thanks very much for being here.
Great to be here. I hope this is the beginning of a great team that we can really talk in depth about the market, where you get to interview me. No one ever does. This is the chance.
It is an honor, and I appreciate the opportunity. So a lot of M&A activity again this morning. Apollo Management bidding for Realogy.
Right.
Harrah's getting a bid, Buymet's getting a bid, and the market not doing a whole lot with it. Is that a sign, perhaps, that the market is tired here?
I think that we had a big week last week. I think that there is a phenomena called hangover after options expiration. Tends to last from 9:30 to around 1 o'clock. And the reason why that is because those who have calls, who are always hoping that Monday will bring good news, they exercise, they get common stock, and they tend to be margin players. If there's no good news between 9:30 and 1, they kick it out. The pressure usually abates by mid-afternoon, and then it's been abating seriously on Mondays by mid-afternoon because of the big mutual fund Monday. We talk about merger Monday, but on mutual fund Monday, a lot of money comes in over the transom. That's through the mail. Because the regular public uses the mail, not wires. So you have the hangover in the morning and then the offset of the money in, which usually produces a pretty bountiful afternoon.
I was going to say, you expect a big final hour trade?
Yes, since May of the last Fed hike, since May of this year, we've seen this phenomena where there is an options hangover in the morning, and it tends to freak people out because there might be good news, and people say, why hasn't the market responded? Give it a chance. The hangover from options, which I used to be very much a part of at my hedge fund, is uniquely related to the idea that the little guy thinks he can get lucky over the weekend, and when he isn't lucky, he doesn't have the money, so then he blows things out. The little guy being almost everybody who's retail who plays calls.
Okay, well, in terms of the little guy, and you're talking about money coming over the transom from mutual funds, my sense is that the retail investor, the mutual fund investor, is still hesitant, hasn't really gotten in with both feet into this market.
I think that's very true. We get cash figures every week, and it's a couple trillion out there. And to be honest, I think it's actually rational. When Chase offers you 5% on a checking account, when CDs are 5.5%. I mean, remember what the world we're in. We had 2% and 1%. Now it's 5%. That is such a cushy thing that to make the leap into the market would be, for anyone other than people in their 20s who didn't get burned in 1999, a kind of a mistake. But what I would tell these people is that the market isn't stupid, and it's waiting for them to come in as rates come down, and you will have to pay higher prices this time next year.
Interesting. So when we talk about the rates are coming down, there's all this M&A activity, ample liquidity, corporate earnings have been great. Mm-hmm. What do you say to those people who say this is as good as it gets?
I would tell you that these private equity firms just started. We see them in their infancy, and right now we only see a couple. We see Apollo over and again. We see Black Rock over and over again. We see Silver Lake. We see KKR. I mean, I think that it's pretty obvious that this is the new game. The press, I think, in many ways, the negative press would call it the new scam. And I think that
it's got to be a scam, right? It can't be good.
The combination is a virtuous circle. The combination of the fees that the Goldmans make, the returns so far from the private equity companies, the huge amount of cash that they have and that they must put to work, and a bond market that is just very desperate for any sort of high yield, means that those who want to say that this is over or a bubble remind me of the people who said that real estate was a bubble in 2003. It was. It was, but it lasted another 2 years. Now, you could very easily argue, Aaron, well, I'm not going to play because it's a bubble. And that's the way it was in 1997-98. Now, those who stayed long got crushed, but those who were willing to suspend it for a moment, and I know that the graybeards hate to hear this, made a lot of money. So I would tell people that it's not as good as it gets. Also, because of the love affair with growth, there's so many companies that are selling at 12 and 13 times earnings that are just kind of saying, I don't need to be public. That I think that anybody leaving the table now would be premature.
Okay, well, as a member of the press, I do have to take the negative side of things, or at least put it out there.
Look, I don't disagree with that. I think that when I was at my hedge fund, we had there was always someone who had to play the role of the naysayer. Typically, it was me. And I think that's because when you have the conflict, you end up with better decisions.
Okay, so my last question then is playing that devil's advocate role. Last week, it seems everyone got into this idea that Goldilocks is here from the economic data. But we also had warnings from Nucor and Illinois Tool and Black & Decker and YRC, the former Yellow Roadway, Are those leading indicators? Should we be worried about the economy?
I've been trying to go over all of those. We knew that there was a glut in steel. What I was surprised at was Newport was probably the most ebullient that there wouldn't be. Yellow why has lost its way. I don't know why it's lost its way. There's the truckers. Most truckers are seeing pretty good business. The rails have seen great business. I think you have to stay away from the industrials, although then we saw a big short in Joy Global that obviously went awry when the earnings reported. Here's the way I look at things. People are headed toward chicken cyclicals. We've seen that before. That's what GE is on the move for, chicken cyclical. We want cyclicals, industrials that aren't going to blow up. I would urge people to look at Honeywell, too. Boeing fits that criteria. Here's what I think people are missing. The Fed doesn't cut on weaker economy. The Fed cuts on a crisis. The crisis, I think, is going to be with Ford. And this is a new view of mine. I happen to like Alan Mulally and what he's trying to do at Ford. But then again, I just can't believe that Ford can pull out of this tailspin without government help.
That's Even though they just raised $18+ billion.
They can go through that pretty quickly, and I didn't like the way they raised it. They raised it at the expense of the common shareholders. Now, it doesn't have to go belly up for things to be... All the Fed has to do is see that Ford is critical, and they would cut. That would really help them because they have a lot of short-term financing. And look, when you have both autos and real estate going down, the other thing that I look for is a big I love the fact that subprime is blowing up. We need subprime to just be annihilated for the Federal Reserve to get off the dime.
So they're not. They think maybe the real estate market isn't done going down yet.
It drives me crazy for people who want to understand that we need the Fed to cut. They almost want to say, we need the Fed to cut. Sure. At the same time, we're not going to get a Fed cut. And here's all the things that are blowing up. It always presumes a kind of a bit of ignorance on the part of the Fed. I remember long-term capital, Orange County, Mexico. These were things that we were all fretting about that in retrospect we should have been saying, as long as I'm not in Mexico, right, as long as I'm not in Orange County, as long as I'm not focused on
Russia's debt or something.
Right. Then I think you end up feeling like, wow, why didn't I realize that it was the negatives that got the Fed off the dime, not the overall GDP weakness, which they kind of view as being neither here nor there.
Or even a good thing because it lowers inflation.
I don't want to be a guy who just looks at everything as a Pollyanna. It's just that every time I haven't, when it comes to a major crisis, I've been blindsided by a sudden Fed cut.
All right, my guest today has been Jim Cramer. Jim, thanks very much.
Thank you, Aaron. More and more.
I'm Aaron Task. Stay tuned for more Street.com TV.